not start with markets this morning since they're not doing a heck of a lot. And I'm going to start with Nvidia because Jensen Huang, the blitz that occurred yesterday, and Jensen sort of becoming almost a celebrity CEO in terms of his public visibility, Dan, has really been an interesting change for him. But he did have a pretty serious purpose with his visit and his speech in Washington yesterday, I should say his fireside chat, which was to get China opened up. So what do we know about what his aims are and how effective they were?
Yeah, I mean, obviously the big deal here is that Nvidia was blocked out of China, then Nvidia was blocked by China. Now they're kind of in this limbo where the US says, yeah, you can sell certain chips, we'll take a cut. There's no movement so far on that front. China is not necessarily interested in having them back at this point. So it appears as though they're just kind of stuck in place. And so Jensen's been pushing this narrative for a while, saying, look, the U.S. has to be in China. If not, you cede the market to them, to local companies, and then they'll just continue to proliferate their own technology around the world. And he likened it in that chat to kind of 5G, where China went ahead and put all of its chips, no pun intended, into that basket, and then was able to export their 5G technologies around the world. And then, eventually that became a thing where we were digging up Huawei cell capabilities here in the U.S. And so, the aims, whether or not they actually pay off, it kind of remains to be seen, but there appears to be some positive movement in that direction. Now, the question is, what chip goes there? Is it the H20? Is it something more powerful? Is it a Blackwell chip? That, again, remains to be seen.
So there's still a lot of questions about all of this, and of course the interrelationship of all of these AI firms as well. Jared, I'm going to toss it out to you now because there has been so much riding on the AI trade, and yet sort of over the tepid action of the last few days, the AI trade hasn't sort of been the dominant factor in markets as much.
And I don't think that's a problem. I think in December, we have lower volumes, we have lower volatility, traders start going on vacation, and you just get some random action sometimes. And people holding out for the Santa Claus rally, that's technically on the very last 5 days of the month. So it starts December 24th. So we still got some time in between. And let's face it, everybody's looking ahead to that big Fed meeting. That's the big catalyst next week. And so we're going to know what's happening with that next Wednesday. It looks like a rate cut by 1 point is baked in, so that would be 25 basis points. And let's just take a look at the morning action here. This is what the indexes around the world are doing, and we have stock futures up in the United States, except for the Russell 2000. That is down 0.3%. But I'll just pull up a one-day chart here of the S&P futures, and you can see pretty choppy overnight action right there. Over the last 10 days, we've just leveled out over the last week, and we haven't done much in the major indices. Yes, there are stories.
Thursday saw a nearly 2% increase in Nvidia shares, beating a mixed overall market. Even though the move's size may seem little for a volatile stock, the catalyst is receiving a lot of attention. The increase follows rumors that stringent new changes on chip exports were removed from important legislation, as well as a high-profile meeting between U.S. President Donald Trump and Nvidia CEO Jensen Huang. Investors view these moves as a policy win that could lessen the chance of a complete lockout from the Chinese market, which is one of the worst overhangs on the company. Fear of stricter U.S. export regulations has been the main factor hurting Nvidia's stock for months. It was feared that Washington will not only outlaw state-of-the-art semiconductors, but also plug the flaws that let Nvidia offer Chinese consumers modified, low-performance devices like the H200. Risk appears to be declining based on recent events. In the first place, Jensen Huang's direct interaction with Trump this week suggests that Nvidia is essentially inside the room when it comes to policymaking. Trump's public commendation of Huang as a smart man who knows the administration's position points to a cooperative rather than antagonistic relationship. Second, and maybe more concretely, the administration formally revoked an AI diffusion rule from the Biden administration that would have placed intricate, layered limitations on chip shipments to third-party nations. This combination of direct access to the White House and the removal of extensive, complicated regulatory frameworks is interpreted by the market as a sign that future regulations would be less disruptive and more focused than anticipated. Exports of the H200 or next-generation Blackwell chips to China may have a more straightforward licensing process, or at the very least, avoid a complete ban, according to growing speculation. Investors are speculating that the government would prioritize American leadership in AI, which necessitates Nvidia's continued dominance and profitability as a worldwide powerhouse. Even while the 2% increase is encouraging, it's crucial to maintain perspective. Due to recent selling pressure and more general risk-on flows into tech, a portion of today's action is probably technical, but it's obvious that the tape story is one of relief. The intraday bid is being fueled by traders who were unwinding their wagers against a worst-case regulatory situation. The lesson for short-term traders is that Nvidia is still quite susceptible to regulatory optics. Any headline implying that the tech war between the US and China is becoming less intense is an instant buy signal. In this sense, volatility is frequently more about the geopolitical rules it must abide by than it is about fundamentals. Today reassures long-term investors of Nvidia's strategic significance. The company's standing as a national champion is further supported by the CEO's direct consultation with the president. The likelihood of crippling, business-breaking laws decreases as long as Washington believes that Nvidia's growth is in line with U.S. national security. This isn't a blank check, though. Export restrictions are still a flexible, non-partisan foreign policy weapon. The trade war is still ongoing, and China's exposure will probably continue to be limited even if one amendment is eliminated. In order to determine whether this policy win is a long-term change or only a short reprieve, markets will now be looking for the next concrete decision, specifically whether licenses for new chips like the H200 are actually given. Nvidia appears to be unstoppable. The company's data center division is expanding at a 66% annual rate, and it recently reported $57 billion in quarterly revenue. Additionally, $500 billion of semiconductor demand visibility through 2026 was addressed by CEO Jensen Huang. Nvidia has emerged as the go-to infrastructure supplier for the generative AI age, with a 90% market share in AI accelerators. However, Alphabet has been developing a substitute in secret, and it's beginning to have an impact. Years before ChatGPT popularized the word AI in 2013, Alphabet started creating its own AI chips. In order to satisfy the computing requirements of Google's search and translate services, an internal project called the Tensor Processing Unit, TPU, was created. It has now developed into a for-profit platform that directly rivals the data center GPUs made by Nvidia. According to published benchmarks, the most recent generation, TPU v7 Ironwood, offers advantages in system-level efficiency for particular tasks while closely matching Nvidia's flagship Blackwell chips in raw computational capability. More significantly, Google Cloud is now offering these processors to outside clients, and some of the leading AI companies are taking note. Google Cloud infrastructure is currently used by 9 of the top 10 AI laboratories. Instead of using NVIDIA GPUs, Apple used clusters of 8,192 Google TPU v4 devices to train its foundation models for Apple Intelligence. Through a multi-billion-dollar collaboration, Anthropic, the firm that created Claude, just gained access to up to 1 million Google TPUs. According to reports, Meta Platforms is negotiating the deployment of Alphabet's TPUs in addition to its own proprietary silicon as early as 2027. These well-known implementations are noteworthy because they show how successful the TPU platform is when used in large quantities. The technology is enterprise-ready if Apple, which is perhaps the most exacting engineering firm in the IT industry, selected Alphabet's chips for its flagship AI project. Training frontier models isn't the true danger facing NVIDIA. The raw power and versatility that NVIDIA's GPUs excel at are necessary for that market. Inference poses a hazard as those models are really used to serve billions of people. Training is a capital investment. To develop a model, you can do it once or on a regular basis. The cost of inference is an ongoing operational expense that increases with the size of AI systems. Analysts predict that industry-wide inference revenue will overtake training revenue by 2026. Alphabet's vertical integration excels in this situation. According to reports, Google's most recent TPUs can perform up to 4 times better per dollar than NVIDIA's H100 for some large language model inference workloads. Following its switch from Nvidia GPUs to Google's TPU v6e pods, the well-known AI image creator Midjourney has reduced its monthly inference expenses by 65%. These savings are not just cost-effective, but also existential for AI startups that are consuming a lot of venture funding. Software, not silicon, was Nvidia's true competitive advantage for 20 years. Significant switching costs were produced by the CUDA programming platform. Universities taught CUDA, businesses implemented CUDA, and researchers produced code in CUDA. Rewriting everything was necessary to leave. The moat is being eroded. In order to enable more effective and scalable calculations, contemporary machine learning frameworks like PyTorch and JAX are abstracting away the underlying hardware more and more. Developers may now run conventional PyTorch models on TPUs with little code modification thanks to PyTorch XLA. Even though CUDA still has a larger and more established development community overall, that lessens the friction that used to keep users locked into NVIDIA's ecosystem. This does not imply that CUDA is unimportant. However, it does mean that consumers may now assess chips more based on price and performance than software compatibility, which supports Alphabet's cost-cutting strategy. The implications for investors. NVIDIA is here to stay. The company's financial results demonstrate real, long-lasting demand, and it is expected to dominate model training for years to come. But it's possible that the days of unbridled pricing power are ending. The most convincing proof? A recent industry research claims that by presenting the plausible alternative of moving more workloads to other hardware, including Alphabet's TPUs, OpenAI was able to negotiate an approximately 30% discount on its most recent NVIDIA hardware buy. Alphabet's presence restricts what NVIDIA can charge, even when customers continue to use NVIDIA. This implies that when competition heats up, NVIDIA stockholders may see pressure on margins. It reveals an undervalued growth engine for Alphabet stockholders. The need for AI infrastructure, particularly TPUs, was identified as a major factor in Google Cloud's 34% increase in revenue to $15.2 billion last quarter. The cloud backlog reached $155 billion, an 82% increase over the previous year. It will take time for Alphabet to overtake NVIDIA. However, the TPU has been effectively positioned as the industry's reliable backup plan, and in a market this size, second place is worth hundreds of billions of dollars. Over the last 3 years, the fortunes of long-standing competitors NVIDIA and Advanced Micro Devices have fluctuated in the artificial intelligence, AI, chip market. OpenAI was able to train ChatGPT in 2022 thanks to NVIDIA's early entry into this market with its data center graphics cards, which set the stage for the company's impressive development in both its top and bottom lines. Notably, NVIDIA's most recent quarterly results show that it is still benefiting from its first-mover advantage in the AI chip market. AMD, on the other hand, arrived late to the AI scene. Despite spending the last 3 years attempting to get closer to its larger competitor, it still trails NVIDIA in this market. This explains why NVIDIA's stock increased by 963% over the last 3 years, whereas AMD's stock gained only 183%. However, it's important to note that AMD beat NVIDIA in 2025, with its stock price rising by 82%, while NVIDIA's increased by 34%. Will AMD be able to maintain this momentum and surpass NVIDIA in 2026? Let's investigate. So far in 2025, AMD is having a fantastic year. During the first 9 months of the year, the company's revenue increased by about 35% to $24.4 billion. According to AMD's current quarter revenue forecast of $9.6 billion, the company is expected to end 2025 with a $34 billion top line. Compared to last year, when AMD's top line increased by just 14%, that would represent a 32% rise in revenue. More significantly, AMD management is optimistic about future growth that is faster. For the next 3 to 5 years, it anticipates that its top line will increase at a rate of more than 35% annually, which is a significant improvement over the 21% annual growth it experienced over the previous 5 years. The company thinks that increasing its market share in the data center industry will be crucial to quickening its pace. This is hardly surprising given the remarkable client adoption of AMD's Instinct data center graphics processing units, GPUs. Many hyperscalers and AI firms, including Microsoft, Oracle, OpenAI, Meta Platforms, and others, are currently using these chips. When one takes into account the income that AMD is expected to make in 2025, the OpenAI transaction alone may contribute $36 billion to its top line during its term, indicating a significant increase in revenue. Additionally, investors should be aware that AMD plans to introduce its greatly improved MI400 series of rack-scale AI solutions and data center GPUs in 2026. Given that AMD has already formed alliances with OpenAI, Oracle, and the Department of Energy, these chips may begin to make a substantial contribution to the company's earnings starting next year. Since AMD's next-generation CPUs are expected to challenge Nvidia's dominance in the data center GPU market, more deals for these chips may be imminent. Although the business may do better, analysts anticipate a 31% increase in AMD's top line next year due to the aforementioned tailwinds. AMD's revenue might rise from this year's expected $34 billion to $46 billion if it can boost its revenue by 35%, which would be in line with its projected compound annual growth rate, or CAGR. Compared to Nvidia's sales multiple of 23, the stock is trading at 11 times sales, a significant discount. AMD's market capitalization might rise to $506 billion if it can sustain its sales multiple after a year, based on the predicted revenue of $46 billion for 2026. That would be 41% more than its present market capitalization, but there may be further upside because the market may place a premium on this semiconductor company given its increasing market share in the AI chip industry. When compared to AMD, Nvidia's revenue growth for the first 9 months of fiscal 2026, which concluded on October 26th, is far more spectacular. During this time, its top line increased by 62% to $147.8 billion. According to Nvidia's fiscal fourth quarter outlook of $65 billion, the company will end the current year with $213 billion in revenue, which could represent a 63% rise over the previous year. In contrast, Nvidia's revenue increased by 114% at the end of fiscal 2025. Thus, the growth pace of the chip behemoth is progressively slowing down. Given that it already has a sizable income base, this is not surprising. Additionally, Nvidia must now share the incremental growth opportunity in the AI chip industry with its peers due to the increased competition from companies like AMD, Broadcom, and Marvell Technology. This is the reason why analysts predict that Nvidia's remarkable rate of revenue growth would eventually slow down. The enormous premium that Nvidia trades at may decline as a result of the slowing growth. According to YCharts, Nvidia has a forward price-to-sales ratio of 20 and trades at 23 times sales, which is double that of AMD. After a year, its market value might reach $6.3 trillion if it does really trade at that multiple. Compared to its current market capitalization, that is a possible 43% gain. Thus, Nvidia might surpass AMD in 2026. However, because of its rapid growth, AMD has the potential to be rewarded by the market with a larger sales multiple. However, Nvidia's tapering growth may lead its premium to continue to shrink. In this case, AMD may continue to outperform Nvidia in terms of returns the following year. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.